welcome to the January 2026 Economic Update from Vision-Based Planning. Want to make sure you guys know everybody on the team. We have some new faces. Camden Elliott and Penny Jones are part of our production for this webinar, and we hope you enjoy what we put together for you. So it's important that you know that we do these quarterly updates because we care about you and your understanding of the markets, the economy, and what we're doing with your money. Our focus is to guide our clients to feel confident in their long-term financial plan and to highlight some of the factual positive and negative data points in the economy. So let's make sure we pull up some slides here as we walk people through what we're doing, but I just want to give you an overview of the format, just some slight changes from what we've done in the past. So first, we're going to talk about the vision-based planning investment philosophy. We're going to walk you through, most of you are familiar with it, but just to set the stage for the economic update. Then we're going to walk through the U.S. economy and some data points that we think you'll find interesting. Then the international markets will be brought into focus. We're going to talk about fixed income and some of the opportunities and frankly concerns that we see in the bond marketplace. And then our very popular food for thought at the end. And that's where we share some slides and some data points that the team find really interesting today. Remember, as always, if you have questions during this presentation, please just throw them into the Q&A section, and we'll make sure we ask them at the end. This quarter, we've actually had some folks come in and send some questions in advance, so we're looking forward to the Q&A section. So with that, why don't we get started and walk through the investment philosophy here at Vision-Based Planning to set the stage. It starts with our 5 rules of investing. And if you have not heard this framework before, let me walk you through it. Number 1, we want to minimize taxes. Number 2, we want to minimize fees. Number 3, we want to remove emotions from the investing process. Number 4, we want to reject gurus, like those talking heads in the financial news media. And number 5, we want to stay diversified. The reason these rules are so important is imagine a world where you empower us to be the stewards of your finances. And over the next decade, we violated even one of these rules. If we didn't stay diversified and over-allocated to internet stocks in 1999 before the internet bubble crashed, or if we started listening to people on CNBC or newsletter writers and making allocation decisions for your money, or if we got emotional and pulled assets out of the market during the COVID drawdown, or frankly, if you paid too much in fees or paid too much in taxes, we do not believe that you would have a successful retirement financially. That's why these 5 rules are so important. And with these rules, it really dovetails into our investment guidelines. So the investment guidelines are in place to help us articulate to you how we go about thinking through philosophically how we manage your money. We start with a globally diversified portfolio of stocks, bonds, and cash investments because we believe that is the optimal way to manage the risk in returning your portfolio. Then we blend low-cost passive investing with high conviction active investments because we know it provides the best risk mitigation for your portfolios. Third, we use exchange-traded funds, also known as ETFs, as we feel they are the optimal investment solution in most situations for our clients. Number 4, and this is important, rebalancing portfolios provides risk alignment. And lastly, the differentiator here at Vision-Based Planning is that we align our investment strategies with the financial planning objectives that you've worked with your team on to help increase the optimal outcomes for our clients' portfolios. So with our 5 rules and our investment philosophy, we then go and implement what we call our ARC process. ARC is an acronym that we have trademarked that stands for allocate, research, reallocate, and communicate. We've trademarked it because we feel this is an incredibly valuable process for putting together portfolios. So first, we allocate to a globally diversified portfolio. And when I say globally diversified, we own companies in Australia, we own companies in Japan, Europe, and in the United States. We want to make sure that we are globally diversified as that provides the exposure we're looking for. Then we go and do research. We look at global macro and market analysis to make decisions on how we might tilt the portfolios to provide those risk mitigation opportunities that we talked about in our philosophy. And then we reallocate. For example, do we want to be allocated more towards the US versus international? Or do we want to go and look at an allocation that tilts towards large versus small? And then, of course, duration is very important to us here at Vision-Based Planning, and we want to make sure that we have our duration situated correctly for your portfolios. And then we communicate, which is exactly what we're doing here today with our quarterly economic updates, our videos, and the team is always available to talk to you about your portfolios. So with that, why don't we go ahead and get started with taking a look at some of the data points that are important to us on the U.S. economy. Penny, why don't I turn it over to you?
Great, thank you, Jay. Let's go ahead and jump into the first slide. So the first slide on the U.S. economy that we're covering is the U.S. unemployment rate. As we can see in the slide, that the current job openings are at 7.1 million. If we remove the COVID dip and rise, you can see that we have more job openings now than we did before COVID. Job openings are a meaningful part of the economy, so we will continue to monitor this important metric. Continuing on, the U.S. unemployment measures how many people who are looking for work who don't currently have a job. Over the past years, this number has been hovering slightly below and above the 4% mark. Here again, looking back before COVID, we are roughly in alignment with where we were at that time. We will continue to look at the unemployment rate on a regular basis. So keep that in mind. And over here is if my pointer is working, Jay, I'm not sure if it is or not, but we have the 5-year at 5% and then currently at 4.4. So we're keeping an eye on unemployment rate and we're not disappointed in what we are seeing.
All right, well, I'll chime in here. So one of the important metrics within the S&P 500, which represents the 500 largest companies in the US, is their earnings. So how are those companies doing? And as you may see on the news, you hear new high, new high, new high. And for some people, they feel excited about that because they know their portfolio is growing. But for other people, they feel a little nervous. They're wondering, when's the other shoe going to drop? And what's important to know and why we host this call is to show you the earnings. So how healthy are these companies? How much money are they making? And so that number right there in the top right, $235, and you look at that trend, even though we're hitting new highs, you can see that the companies are healthy and their earnings, the profits that they're bringing, is moving in the right direction to support those new highs. So for example, going to the next slide, as you see the S&P 500 price, hopefully by sharing the earnings, you can, if you're in the camp where you're wondering when the other shoe is going to drop, you can lower that, I call it brain space. You can get that brain space back and be like, okay, I'm okay with these new highs because I know that the earnings are healthy within the US corporations. With that, let me shift it back to Penny, who will unpack inflation for us.
Thank you, Chris. All right, so jumping into CPI, or Consumer Price Index, we can see the contributing components or channels through which inflation hits the economy. While most of the minds are focused on what inflation is doing, the bigger question is what part of the CPI are changing and why. So if we look at this chart, we can see it's kind of color-coded, which I personally like. So I can see the division of what the areas are changing within CPI. Looking at the green, which is energy, we see it as a big factor in 21 through 22. A lot of impact into energy that impacted our inflation, our CPI during this time, but it kind of disappeared as we move forward. And as of November 2025, we can see the green starting to reappear. That tells us energy is starting to come back and is starting to have an impact on our inflation. Another area to consider and to look at is the food at home, which is purple, and the restaurants or dining, recreation, and other services, which is in light blue. So during COVID, yeah, a lot of us were eating at home. That was pretty much the only option that we had. But as we go to the right, we can see that eating at home has very much decreased, but the restaurants or the dining, recreation, other services is not decreasing. Now, eating at home and restaurants are kind of a competing factor. So that is something you're going to eat, where you're going to eat, that has an impact into inflation. But I don't know about you, but I can go through town, I can go look around, driving through, and I see parking lots full at restaurants. I still have to go onto my app and say, hey, I want to get in line for this restaurant. I'm still waiting to be seated. And so that is a great indicator, because anxiety around food is a big I guess, flag that we see. And we're not seeing that. We're not seeing people panicking because they're still eating out. They're still going places. So that is perfect. The little diamond at the top tells you where the inflation is. And as of November 2025, average inflation was 2.7, which in the big scheme of things is still really not that high. Jump into the next slide. Let's see. Getting this to come through. All right. I guess this will slides for me too. All right. Talking about the gross domestic production, it's commonly heard as GDP, is another word for U.S. gross. So based on the latest quarter results, the U.S. is growing by 4.4%, which is very good. You can also see that the long-term average is 2.75. So we are happy to see this latest metric and that we are above average. GDP is an effect from other various causes within the economy, and we are happy to see the good results and from the positive causes as well. So looking good, feeling good about this, Chris. And
yeah, I like it.
Glad to see GDP. Jay?
Thank you, Penny. Thanks, Chris. As a reminder, our fourth rule of investing is to avoid gurus, and that includes the financial news media that try and bait you in with headlines. And that's why we like to look at the data when we build portfolios. So recapping what we're seeing in the economy today, job openings remain strong with over 7 million jobs available. Inflation remains in check overall. S&P 500 earnings are outpacing price appreciation right now. Very positive sign for investors. And lastly, as Penny just pointed out, our economy is growing as measured by GDP at a very historically strong rate of 4.4%. Our concerns and the data on the radar that we really want to pay attention to is net new jobs has really slowed down. So we're going to continue to watch that metric. And the S&P 500 price to earnings ratio is a bit inflated. So we want to pay attention and make sure things aren't becoming too overvalued as we move forward. With that, let's pivot to the international markets. Penny, do you want to kick us off?
Yeah, absolutely. So the Eurozone has roughly 4 million job openings currently, which just indicates that their economy is smaller than ours. Their unemployment has been trending down, which I'll show you on the next slide. So importantly, what this means is that in Europe, as jobs are opened, they are getting filled. Looking at the next slide, we can see the downward trend of unemployment in Europe, which is why we feel good about that part of the world economy. Japan's unemployment, however, is relatively low at 2.6. And they have other issues, which we can talk about in this next slide also. And finally, let's talk about the global inflation. So in Europe, inflation is reporting fairly low at 1.9%, which is positive when coupled with the declining unemployment rate. This is where we jump back again to Japan. On the other hand, Japan has seen rising inflation to 2.9% and has some larger fundamental issues. Chris, can you comment on those in the next slide?
Yep. So tying back to the comments about the U.S. earnings and how companies are doing, let me just share with you what you're seeing here is what's called the price of the S&P 500 or the EFI represents international. So you have price divided by earnings. So I covered that earlier with the S&P 500, showing that you don't need to be worried about these new highs because the earnings support the growth. That 23.9 is represented in the US. Internationally, the price divided by the earnings is lower. So it's showing that this is actually a more attractive space. And going back to Jay's philosophy about remaining diversified, which is why we own international investments. And looking in the rearview mirror, looking at those international investments, they've done quite well for us in the last year, starting in 2025 and moving forward. Let's get into the next component of international growth. So again, gross domestic production is another word for growth. So in blue, you see the Eurozone growth. Europe's economy is smaller than ours. So their growth percentage is smaller. They've grown by 1.4% in the last quarter, slightly below their longer term average of 1.5. Again, I'm not that concerned about Europe because I'm happy to see the job growth and I'm happy to see the unemployment rate coming down. Japan is a different story, however. Betty, your applications are on the
Sorry, apparently we're going to try to.
yeah, Apple's got
There we
a
go.
there we go. All right, very good. Japan's another story. So Japan has some larger issues with their demographics, and they have some issues with their currency. So you're seeing that black line, and you see that dip. So their economy is actually shrinking when you measure GDP. So you see a negative 2.3 number. They also have some issues with their currency in the sense that the Japanese yen is inflated. The issue with that is when you have or I should say higher, when you have an expensive currency, it makes it less attractive for other countries to want to import that. So it slows the economy down. So that's on our radar. We're aware of what is going on in Japan. And going back to what Jay is commenting on, we're not hosting this call to just tell you everything's great, everything's great. We're hosting this call to share with you the data and separate the true positive components and not hide from other data points like what's happening in Japan. So having said that, this last slide we're sharing with you, and if you focus on the circle into the top right, is that global tensions remain. And if we go down this list, you're aware of everything that's going on. China, Russia, Iran, North Korea, Belarus, Venezuela, Cuba. This has been in all of our news feeds over the last 30 to 60 days, practically everyone on that list except probably for Belarus. So these issues are relevant and important from a humanitarian standpoint, but it's also important not to let global tensions affect your investment strategy. So while some of these issues here are humanitarian issues, like you specifically take Iran and how people are demonstrating and just being just horrific. You can't even find the words to describe what's happening in Iran. We don't want to let some of these global tensions affect our investment strategy. So we're aware of what's happening. It's an overlay, but it's not a driver. So we wanted to share that and feel that this is a helpful section to say, okay, yes, these are concerns, but we're not going to let it influence our investment strategy unless it should. and which in this case it's more humanitarian than it is economic indicator related.
Yep. Very well said, Chris. Incredibly important, along with our third rule of investing, is to remove emotions from the process. And we don't want politics or things that aren't going to impact long-term finances for our clients to have us make knee-jerk reactions in portfolios. That's why we look at the data, and here's what the data has told us about the international markets, as Penny and Chris just walked through. Both in Europe and Japan, unemployment remains low. Also, the global inflation really remains steady and in the lower range of what we would want to see. The concerns we do have, Japan has some issues. GDP is negative. They have demographic issues. Their currency has some challenges. So we're making sure we pay attention to the data around Japan. Global tensions are there. We're monitoring them to see if there are applications for portfolios. And then Iran and potential challenges. That is on our radar, but it's not causing us to make any moves inside of portfolios today. So we've covered the U.S. economy and markets. We've covered the international economy and markets. I want to talk about fixed income and some of the data points that I think you should pay attention to as it relates to bonds. Remember, the bond market is significantly bigger than the equity markets, both here in the U.S. and overseas. Historically, investors have thought of bonds as being safe investments, and they are a great balance to a globally diversified portfolio, like the portfolios we build here at Vision-Based Planning. But it's really important that we pay attention to interest rates and where we are investing in bonds. So the first thing we look at is called the Fed funds rate. This is the number that you see in the headlines. This is the rate that the Federal Reserve sets. In fact, it's the only number that the Fed can go and dial up or dial down interest rates. Currently, Washington is on a pressure campaign to bring this rate down. So the short-term trend for the Fed fund rates has been trending down, and that has resulted in short-term fixed income prices or yields coming down as well, as you would expect, particularly around safer treasury type investments. But here's the important part. We want to look at the 10-year treasury rate. The reason we want to look at the 10-year treasury rate is, unlike the Fed funds rate, nobody can go out there and bring this rate down automatically. This rate goes up or down based upon the forces of the markets, which is why we pay attention to this rate so closely at Vision-Based Planning. And you will notice that the 10-year today is sitting at 4.2%. So the Fed started lowering rates, but the 10-year rate did not come down. And that's very important when we look at your fixed in portfolios and the important duration metrics that we like to look at to make sure that we are protecting clients' portfolios in the fixed income space. One other thing that I hope you take away from the interest rates today. The all-important 30-year mortgage is predicated on the 10-year rate. And so what that means is, as the 10-year rate goes up, we are going to see the 30-year mortgage rate go up. And where that presents a challenge is the housing market, it's frozen right now. And so you've even seen some talk out of Washington to try to come up with ways to usurp the 10-year being the driver of the 30-year by taking action in the bond market to try to bring this down, because they're trying to unthaw the housing market, which is a huge driver in the U.S. economy. So we are paying really close attention to all three of those numbers as we manage your bond portfolios. One last thing to note before we wrap up fixed income is that we find it very important today to focus our fixed income investments in the United States. What you will see here are the global bank rates across the world. And historically, they're low, they're a little hard to follow, and they don't have the same predictability as U.S. fixed income rates. The reason today we choose not to invest in international bonds is they come with a whole lot of risk. And as you can see from the rates on this chart, they don't come with a whole lot of return. We'll continue to monitor this as we go forward, but remember, we believe it's very important to pay attention to the risk in the fixed income space. So with that, I want to just give a quick recap on fixed income. The Federal Reserve has cut interest rates since our last update by 25 basis points. The Bank of England, they're trying to cut rates because they're hoping that will spur growth for England. And declining interest rates overall can increase bond values, but we're not sure of the market dynamics and what that would mean for investing in international markets. Concerns: Japan's GDP is negative, and they're having challenges with their interest rates. And higher interest rates can sometimes exacerbate deficits for spending here in the U.S., which is something that the administration in Washington that's why they're trying to get rates down, to provide some relief there. Keep in mind, we have some Fed meeting dates coming up here in January, and then again in March before we meet again. The team will be paying close attention to that. So with that, before I turn it over to our food for thought, remember, if you have any questions, please type it into the chat. After we get through our food for thought slides, I'll be able to pose the question to the team.
Thank you, Jay. Good reminder. So jumping into food for thoughts, I want to hit a little bit on interest rates and duration. Sometimes those words kind of get confused and what does duration means. And so basically, let's just break it down a little bit. So there is a seesaw relationship between interest rates and the bond values. So bond values rise as interest rates decline. And the word duration just pretty much means where we are sitting on this seesaw. The longer the duration, the further you sit away from the middle, the triangle, or the fulcrum. And this is because we are expecting interest rates to continue to decline over the next 24 months, we are focused on where we sit on this seesaw. Moving to the next slide.
Yep. I wanted to cover tariffs. Tariffs have been a big part of the conversation for almost a year. This started back in February, March, April of last year. So what you're seeing here is the tariff revenue by month. And this is a slide from JP Morgan. So you see tariff revenue from September, this is just still data we're gathering, was $30 billion. If you draw your eye to the left, you'll notice that this is essentially ramped up over time. There is some concern that the Supreme Court may rule against the policy that this administration has used to gather the tariff revenue, and it's only one subset of how we're generating this revenue. And this number here, the 174, is actually half of the total. So we've actually generated around 300 billion. What I'm trying to say is that even if the Supreme Court rules against this emergency clause, there are two additional clauses that the administration is going to put in place to retain the vast majority of that revenue that's been generated. So this administration's used this tool as a negotiating technique, which I think has been effective at negotiating, but it's also been effective at raising anxiety and stress because we've all been dealing with that. It's important to know, and it's been, I'll say, a concern for me, is what happens if the Supreme Court rules against all this tariff revenue? And it's important for you to know that there are two additional strategies or laws that would be put in place to essentially retain that income. So it'll be a little symbolic, the Supreme Court ruling, because it's not going to unwind the revenue and the dollars that have been generated from this policy. Okay, next, this is a slide from Fidelity. This is showing you the business cycle framework. Let's focus on the US for a moment in green here. You see we're towards the later part of our economic cycle. Ken and I, we actually attended a lunch with Fidelity yesterday. So the US has essentially moved itself back in the economic cycle. It's not just a one-way street in the sense that our economy is growing, we have healthy jobs, and unemployment or inflation is not becoming a friction point. So we don't want to see, so to Jay's point, the Federal Reserve is meeting today and tomorrow. we are not expecting interest rates to decline because there's no reason to. If you think about if you were the chairman of the Federal Reserve, think of interest rates as like dry powder. You can put that in your rifle and you can fire it. You want to save that dry powder. So as we move further down into the later stages of the economic cycle, that's when it's appropriate to lower interest rates to drive ourselves out of what will be a recession one day, but we don't see that anywhere on the horizon. So we can spend quite a while here in this part of the business framework, in this business cycle, which is what we're expecting for at least the next 12 to 24 months. I think I'll mainly focus on that. You see these other countries, you see Japan and the Eurozone, and even China and Japan coming out of their stage and moving into growth. So we thought you might appreciate this slide and just see where different countries are within the economic cycle. Okay, and the last piece I'm going to share in terms of the food for thought is important for us to just mentally process. So what you see in blue on the top is the S&P 500. Drawing your eye over to the left, how often do we see a decline of 5% or more? And you can know it's 3 times a year. So the market's going to go up 7 times out of 10. We'll see a downdraft. If you think of 10 quarters, 2.5 years, 7 out of 10 quarters, we're going to see green numbers and growth. 3 out of 10 quarters, we'll see some red numbers. 3 times per year, you see a dip of 5%. It helps when you get off to a good start in the beginning of the year and it doesn't happen right away. But 3 times a year, you can see a 5% dip. Going to the next one. How often do we see a 10% dip? About every year and a half. How often do we see 15% dip? Every 3 years. How often do we see 20% dip? Those are those big jolts. That's every 5.5 years. So interestingly, if you draw your eye to the top right, you see April 2025, 5%. April 2025, 10%. April 2025, 15%. That's why you heard me say that April date, because that's when all that tariff happened last year. All of that happened at the same time. And okay, October 2022. So when do we see the possibility of one of those next jolts like we felt in the beginning of last year? We have some sort of clear skies ahead. So we feel optimistic about where the economy is, both in the US and internationally. So overall, this economic update thematically is positive, but importantly, not just falsely positive. It's for good reason.
All right. Thank you, Chris and Penny. Let me recap this. Again, if you have questions, please put them in the chat. So what we see from a positive and an encouraging standpoint is the U.S. has moved itself back in the economic cycle. Tariff revenues are not increasing inflation as originally thought, and declining interest rates will increase those short-term bond values over time. Of concern still today for the team, U.S. deficit spending and our debt to GDP ratio is still a little higher than we would like to see it from a historical perspective. With that, team, I'm going to pose our first question from Paul. You mentioned gurus. What are your thoughts around James Altucher predicting significant increases in values in AI-related fields, such as communication technologies, that may have a significant announcement soon? Or is this social media hype? Chris, I think the spirit of the question is, how concerned should we be about AI in our investing process?
Well, and so the difference now with AI now compared to, for example, the tech bubble is that the tech bubble didn't have revenue. And so that was like building the internet, and a lot of the valuation at that point, or the pricing behind where the market was on hype and on the expectation. The difference now, when you see companies that are investing in AI, Microsoft, Google, Amazon, they have revenues and they're spending their own money. So it's not like Google or Microsoft are building these data centers and they're going out and selling bonds to do it. They have the cash. They're just paying cash to do it. And we didn't talk about this, the tax law, the one big beautiful bill, which we all agree is sort of a dumb name, but there's really tax law there. There's legitimate real tax law that was put in place in July, which helps write off these business expenses, these business investments that are being made. So I see them as being investments, and I'm less concerned about, just leave it at Microsoft. Microsoft investing in AI, and that being an overall concern. I mean, Jay, sort of tossing it back to you, what's your reaction when you see this question?
Yeah, it's a really common theme that has investors concerned. They're concerned on many levels. If you have young children or kids in school, how is AI going to impact them? How will it impact the economy? I can tell you from an application standpoint, there's a lot of hype around AI right now. It's a very useful tool. There's a lot it can do, and it will only get better. But I think avoiding the noise and the gurus around, and I'm a big fan of James Altucher, by the way, Paul, but avoiding the noise around it taking over everything in the next year or two, I think is really helpful from an investor standpoint. And Chris, to your point, the big companies are winning by using it to help increase their profit margins. That just helps investors. Yeah.
Good.
All right.
While we're waiting for more questions, please give us your feedback. So, we're at about the 35-40 minute mark here. We have our pre-prepared slides and comments for your update, but we also want your feedback. So you're noticing we're making some changes. You're noticing some of the slides are changing. Give us your feedback. We want this to be informative and get to the data points so we can show you what's important, whereas the news media is not, it's more opinion based now. It's like, depending on where you're sourcing your information is how you'll influence how you feel. And we're just wanting to give you, so anyway, long story short, give us your feedback. Let us know, what do you think we're doing well? And more importantly, how can we improve?
Excellent. Chris, a question we had in advance around how we're thinking through the midterm elections, any impacts that we should be concerned about. You've kind of addressed it earlier, but let's hone in on that.
Midterm elections is great. And thank you for asking that, Jay. So talk about preempting or preparing for volatility. So volatility simply means you look at is the fluctuation of those balances. Midterm elections are in November. As we work towards the fall, just naturally, there will be more volatility in the portfolio. And that's just a byproduct of that seasonality. It's not affecting the fundamentals, and you'll be hearing us say that because we're going to be focusing on the fundamentals. It's that the distraction of the politics will influence your portfolios, but it won't influence the fundamentals. The other interesting piece that was shared yesterday at this Fidelity lunch that we went to is that when you look at the midterm election of every presidential election going all the way back to the Great Depression and the 12 months after that, not one time have you seen a negative number, which is a very interesting data point from Fidelity, which is to say, yes, we're going to have volatility leading up to November because of uncertainty. But when you look at those 12 months from November of what will be 26 to November of 27, and it could be a little data mining, which I'm always very sort of leery of, like moving the numbers around. There's a saying, you can beat the numbers to get them to tell you whatever they want to tell you. You just have to use this much, right? Use this much, right? So I can make the numbers tell me whatever they want, but it's important to know, and I find it interesting to know that when Fidelity says that from November of 26 to November of 27, we've never seen negative returns for the 12 months of any administration after the midterm election. That stands out to me as reassuring to know, okay, we can be confident in these numbers and the fundamentals will prevail long term versus the short term and near term emotion that we will see as we head towards November.
Yeah, excellent. Subjectively, I think if you think about a house flipping and having gridlock, all that does is help businesses operate because they have clarity because there's gridlock. So I can see where that data point really has some legs to it. We have a question coming in from Chris. So Chris asks, shared an article about from CBS News, and his question is, are there any concerns of more sell-offs in global investments that could affect the U.S. bond market? Or is this just business as usual with this $100 million sell-off? And he has a link to an article that looks like the Danish pension fund may have sold off some treasuries because of actions from Washington. Chris, so I think the spirit of the question is, any concerns about potential foreign governments selling off U.S. treasuries?
This is a great question, and Chris, thank you for asking it. So what's this feeds into where do we get our news data from? And should we be concerned? The amazing thing about our Federal Reserve is we are our own bank. So if someone wants to sell government bonds, who's going to buy them? Us. We just buy them back. We just take back our own inventory. So if the Danish pension fund is concerned about U.S. bonds and they want to sell them, they're typically it depends on the price. What are they selling them? And if they're fearful, they're probably selling at a price below what it's worth. And who's on the other end of the buying? Us. You could be a little bit cynical about it, but we issue our own bonds. We buy back our own bonds. We are our own market maker within fixed income, within U.S. Treasuries. So I love the question. And what also jumps out at me is this Greenland thing, which is sort of an interesting reality. Again, it's not going to drive our economic policy, but it's interesting to watch us and this administration's approach, which I think, speaking for all of us, we wouldn't approach it the same way, being the bully in the schoolyard. But I think for Europe, just to comment on Greenland a little bit, Europe doesn't mind us putting a military presence there because they'll benefit from our presence there. They're just bothered by the approach. And so is everybody. It's like you're the bully in the schoolyard going into Greenland, and it's like, couldn't you do this a little bit more tactfully? But, I think ultimately the world being safer and protecting against the powers of Russia and China are the right thing to do. But if the administration could do it in a more tactful way, everybody would be a lot happier about it. So I sort of got off on the Greenland thing because that's, I think, part of what the click reaction is, oh, should I be concerned here? So in a very long-winded way, Jay, I would say the answer is no. What's your reaction when you see this?
Yeah, and Chris Chang, I think that's a really valid question, and I can see why you would be concerned. It's been said that the U.S. for a long time has had what they call an exorbitant privilege of being the world's reserve currency. And what that has enabled us to do is exactly what Chris just laid out. If there's problems with people selling our debt, we can just go out and buy it. And that's why we try to focus on U.S.-based bonds for those portions of our portfolios. It does create headline risk, but we try to avoid that type of emotional response to stuff because we've already put those protections in place in our client portfolios. So excellent way to talk that through, Chris. Yeah. I've got one more question. I want to talk slowly, so if anybody has any other questions, they could put it in the chat. But I think this last one has been on everybody's mind. Precious metals have been on a really big run. What are your thoughts, and what should investors think about when they hear or see the headline news that silver's trading over $100 an ounce and gold's trading over $5,000 an ounce? What does it mean, Chris?
Well, gold and silver are what we describe as fear-based assets. So when you think of gold being on that high price, it's because there's typically concern elsewhere. And so the concern there would essentially be US spending. And we didn't show a chart on it, but we're highlighting it on our concern, which is the US continues to spend and we issue bonds and our debt continues to grow. And so when you see something like gold rising, it will typically be because the US's ability to continue to fund our own spending. And it also means there's more buyers than sellers. So it means that, which can sort of feed on itself, which is like something, there's a trend and it's like, ooh, I want to get that because this trend is in place. So it builds, it sort of winds its way up because there are more buyers than sellers. But it tells me that there's concern elsewhere because of our U.S. spending. Jay, what do you think?
Yeah. So I remember back during 2020, and there were these things called NFTs that were launched, non-fungible tokens. And they were literally just pictures, JPEGs, that you could go and buy and sell. And there was all this extra free money floating around because the government was sending everybody checks as they were locked in their house. And that money started going into buying essentially pictures. And the most popular pictures were of these monkeys. And
Yes.
if you did not experience it, you wouldn't believe it. But people were paying hundreds of thousands of dollars for pictures of monkeys that would sit on their computer. And it got caught up in this kind of mania and frenzy. And so I'm not saying that is what's happening today, but when you look at the charts, particularly of silver, it looks a lot like those charts. So when taking it back to our 5 rules of investing, if somebody wants to own some gold or wants to own some silver, maybe there's a place for it in the portfolio as long as it's globally diversified in a very small part, but don't get caught up in that type of hype like we experienced in 2020.
Yeah. I guess, and then the only other thing to unpack that a little bit is that gold doesn't have as much of a utility. It has some utility, and silver has some utility because it is conductive, which means, so as we think about AI and all these data centers and all the fine metals, the gold and silver, because of the conductivity there, yes, there is a utility there, but not as much that's supporting the price appreciation, that the winding up that we're seeing. So there is some utility, but the price is beyond just NVIDIA GPUs and all of these other chips that are being produced, purchased, and used.
Great point. Yep. There's actually tremendous utility, right? But you don't want to go and cash in your 401k and head down to the pawn shop and buy gold and silver.
Yeah. Yep.
which you end up reading about. Okay, everybody, that is all of our questions. Thanks for tuning in. As Chris mentioned, we really would like your feedback. We've made some changes to the format because our goal is to educate viewers and make sure you guys understand what we're doing, what we're looking at, and how it impacts you. Thanks, everybody, for tuning in.